This next part, I wanted to do this for everyone here because I have a lot of people. I haven't even really discussed any of this with Andy or we haven't ever really spent any time diving in and talking about it or any of those things. But I have a lot of folks that call up and want to know, how do you come up with all this information, or how do you get this part here, the charts, right so frequently, I guess I should say, as far as general market direction. One of my rules, too, of trading or speculating, or if you're a producer, I would suggest if you are bullish longer term, I would be very cautious of taking positions on the short side. It's cost me several times. I think it's cost a lot of people in here several times. Prime example, recently in cattle. I tried to get cute. I thought, boy, this cattle surely made a run higher. Tried to short some. I knew better than to try and short cattle as I'm sitting here bullish longer term the cattle market. Sure as hell, went home, told Michelle, got smarter today, paid for another course in learning. So got smoked, we got stopped out, and we tried to go against the grain. What I've tried to do, and why I think I'm different from most, and like I said, I haven't really discussed this with any of the traditional traders, I should say, or the guys we used to trade with in Chicago and those things, but I think the game's dramatically changed, period. I don't want to throw anyone under the bus, but the way my mind works, and this is what I'm going to tell you, I want to give this to you guys and see what you can do with it. And I'm just going to tell you how I come to these conclusions in my head and how I see it and why I think things have changed so much and why I don't feel that supply and demand is as important. And I don't think they're reading the coverages of the schemes right. With the sports background, any of you played quarterback or anything, I had an opportunity to work with some great quarterback coaches. You come to the line of scrimmage, and as you break the huddle, you immediately look straight down the pipe to find the safety. The safety is going to be your key. As Jay will tell you, we're going to be in cover 2, cover 3, where we're at, whether we're going to be in a zone or whether they're going to drop up. If the safety comes up here, we got a chance they're in nickel, chance they're in dime coverage. So as I break the huddle every morning and come to the line, I got to figure out who's straight down the pipe. And then from there, I will determine where we go in those directions. A lot of people have a problem understanding the players of the game. The quarterback's generally taken first by every team, but who's generally one of the most important picks in the draft after that? Left tackle. Most quarterbacks are right-handed. Left tackle. Left-handed quarterback be a right tackle. Why? You're not going to buy a Ferrari and not have a good garage to put it in. Understand that. You got to know the players. You got to know what's important. What position is absolutely the most imperative. I believe supply and demand no longer play safety. I believe supply and demand's up here playing somewhere like maybe Mike linebacker or somewhere, maybe Will, somewhere in that field, but not safety. I believe when you break the huddle and you're looking straight down the pipe at politics. You get the U.S. dollar right, you're probably going to be on the right side of the trade. Understand the way politics is painted. Understand where volume is coming and money flow is coming. Understand that you got to try and make, as a quarterback, why it's such an important position, because you got about, you look at the play clock, you got maybe 20, 22 seconds to assess. You come up, you take the snap, pre-read, you're going safety, then you're immediately looking left. Read your linebackers across, look right, read your D lineman back across and left again, and you're ready to snap. And you got to make a decision within that time frame, similar to playing catcher. As you do that, similar to the markets, you immediately have to try and process. Are we positive? Is this guy showing this coverage? What are we seeing from these people and these players? I'll equate it a lot of times in the report, whether it's handicapping horses or we're trying to count cards. Andy and I played blackjack together in Vegas. Andy's an incredible blackjack guy. But you have to know how the deck's stacked. Is the deck more bullish or is the deck more bearish? Supply and demand is a small factor now with the way things have played out, so to speak, and moved. And moving forward, the way the traders are trading and the macro type views that they're looking at. So I want to give you just a look behind the scenes and at my thoughts in the morning as I put this together, how we were able to move to a bearish tone when we went above 750 or 780. And everyone's like, you're nuts. And, maybe. But the way I seen it, the coverage has changed. The defense changed. Just like the game changes of football. I could go out there and run power I, like the old grinded out style, 3 yards and a ball of dust. Well, hell, now we're running wildcat and we're running everything else. So the game changes. Traders have to change. You have to understand the way the game's moved. It's faster, just like on TV. NFL's faster. Defenses are different. Schemes are different. Trading world is different. Understand that as we move forward. Traditional thinking's probably not going to pay off, I should say. I talk to this all the time. Games change. Here we go. This is, money flow coming in. We didn't update it, obviously. I say it all changed about 2005. I think some will tell you 2002. I'd say 2005. CME changes position limits. We go from 5,500 to 13,500. All of a sudden, the funds are fired up. The funds are now in the game. Look, positions are changing. Players are moving. We go from 5,000 position limit, 5,500 to 13,500. That's like going from man to nickel coverage. We just flipped. The whole thing just changed. Make the reads. Make sure you understand what we're doing as far as this goes. Same time, 2005, renewable fuel. As Andy says, Tom says, huge game changer. Same exact year, same thing, things started playing out, and all of a sudden we get the explosion higher. One thing we have to remember, zero-sum game. I tell everyone, you have to know the game you're playing. Make sure you're not playing touch football and the New York Giants are coming to town with all the right gear and equipment. So you think you're playing touch football in the backyard, but that's not the way it is. That's not the way it's being played right now. Commodities, for every buyer, there's a seller. For every seller, there has to be a buyer. This isn't like stocks where we all stand on the same sideline and cheer. I mean, we just issue more shares, maybe do a 2-for-1, things of that nature. This isn't the case. Commodities, zero-sum game, you against them. Buyers, sellers. That's why the Hunt brothers got smoked in silver. They went to sell, there were no buyers. Understand, supply-demand numbers might not mean everything in those scenarios. This is not like that. It isn't like stock market. That's why wheat, I say Chicago Board of Trade wheat contract's broken for the most part. I mean, you can say what you want. Any given time, we'll say 450,000 open interest. That equates to 2.25 billion bushels. Problem? We'll only produce about a fifth of that, 450 million bushels. So in the past, when you had commercial interests that could offset the specs, that's no longer the case. It's not the case at all. It doesn't happen. It doesn't equate. That's why you get the extreme volatilities, as Andy was talking about, in the Chicago Board of Trade wheat contract. You have the world and the hedge funds, and the index funds and every other fund that's out there trying to make a play in ag in wheat. You've seen more as of late make the push over into KC wheat in Minneapolis, and I think that's going to become more prevalent. But it just gives you the background as to why I say the offenses or defenses have changed. They've evolved. They've become so much different now. We have to be aware of that. We have to look at that. Understand these terms. These are the new terms. Reallocations, rebalancing, redemptions. Huge, important terms. We'll start off, I tell everyone, it's simple. We'll say, let's see, who do we got down here? Where's Steve Musselman? You're here. Steve, raise your hand. You're my hotshot new hedge fund guy from Harvard. I'll be an exec from one of the, I'll be an exec from one of the, the elite banking firms. I hire Steve. Steve comes in. I give him $6 million to manage. I say, Steve, I need this to be a balanced portfolio, a balanced hedge fund, because I'm going to sell this to the pensions. I'm going to sell this to the retirement of some of the biggest retirement, investment firms out there and things. I need a balanced hedge fund to do this. I know some of you have heard this spiel before. Steve jumps on board and he puts $1 million into each one of these and creates a balanced hedge fund. $1 million in grains, $1 million in currencies, energies, metals, livestock, right across the board. Steve catches it right in crude oil. Crude oil goes through the roof. He catches it down at $80. Crude explodes. All of a sudden, Steve's sitting on $50 million in crude oil. I go to Steve. Steve's fired up. He's happy as hell. He thinks this is great. I say, Steve, we got an issue. You know that balanced fund that I had sold to this pension group a while back? It's no longer a balanced fund, and they're kind of complaining because it's like an energy fund now. We got $50 million in energy, and we don't have that much in the rest of the sectors. So Steve says, oh, man, boss, sorry about that. What do you want me to do, liquidate those crude oil positions? And I said, well, hell no, we're not going to liquidate the crude oil positions. That's the big seller. Every investor wants to see that we caught that bull run. I mean, at the end of the day, and when the smoke settles and dust clears, I want to make sure that I tell them you did a great job and caught that energy run. So I'm not liquidating crude. I'm probably going to have Steve balance up the books, balance up the fund to be balanced by adding positions in the ancillary markets and the other markets. You have to understand that. So you have to look at the other markets and really, really understand how those markets are moving to how that plays in with some of the bigger funds and some of the more balanced funds. Reallocations, rebalancing, redemptions, what I was telling Mark the other day, I said, we have, I don't know, there's countless number of hedge funds that subscribe, and I'll call in the office and we'll talk, and I think there's a fear in a lot of them right now. You're seeing, I would say, I think they told me the stat, 15 to 20, they get paid in two ways. They usually, generally they'll take a 2% management fee, and the market rule is generally about 20% incentive fee. Understand, the incentive fee generally never kicks in until they go past the high water mark. Understand, high water marks were set probably 07, 08 in the heyday, boom. That set a high water mark. Since that time, they say, these guys are telling me 15 to 20% of the smaller funds have not collected an incentive fee in that long. That is a problem. The big funds now, the big players, Paulson and those guys, the bigger funds can operate on a 2% management fee and tend to grind it out. The smaller funds, that's not really the case. Now you're seeing a type of, you're seeing funds start to close. You're seeing fund money start to trickle back in the form of redemptions. You're seeing hedge fund traders get more aggressive, a lot more aggressive, because they're looking at it like now they are trapped into a corner. Last year, the average hedge fund, I think we returned negative 5%. The S&P index returned plus 2%. Once again, they're falling deeper into a hole. To get past the high water mark and get their incentive, they got to hit some home runs. Understand, to hit home runs, they got to load up. So I'm telling you, the volatility is going to intensify, and you're going to see funds probably puke. If they don't hit it this year, you're going to see more funds closing down. That's all there is to it. I've talked to too many guys. There's going to be money pouring out. And I'll tell you the other equation. If this stock market takes off and rallies, you're going to see money move out. Watch the stock market. We're already up 8% in the S&P right now as we sit here. If this stock market takes off and runs, Andy and I worked together through the 90s. If you're earning 15, 20% in the stock market, and I'm the CEO, I'm probably taking some of that money from Steve Musselman that I gave him in this hedge fund, and I'm moving it over to the equity desk. There is not one firm in this country that can afford to miss the next big stock market rally. None. They got too many people that took it on the dive down, and no one wants to miss it. They are itchy on the trigger finger with these equities. That's why equities, that's why when I was telling you guys earlier in the year, back when, early in December, I said, be careful getting short this stock market. I said, if anything, play this thing to the long side, because politics are trumping this bad boy right now. And they had the hedge funds. Remember when I was talking about, they had these guys. The S&P was up, say, 2%. They go by, these hedge funds and all these fund managers are graded by the indexes, so to speak, that represents them. All of a sudden, the funds were down. They were negative 3%, negative 4%. The S&P's trading even to right in that area. They could not afford to miss that run, because all of a sudden they'd be judged against their index or their peers. They'd be negative. It would be positive. That mentality means a lot. That mentality trumps these supply-demand numbers. That mentality takes you to where you have to, you have by necessity to save your own ass and to save your job, you're going to be on the long side of this thing. So understand these I guess you would say these people's mindset as they approach and move forward. And I got to get everyone on this page in here if we have any hope of trying to predict general market direction. The short intermediate term ticks and trends, that's a fool's game if you ask me, if you're trying to pick tops and bottoms. We got to try and just predict general market direction and stick in those vicinities. That's where the money's to be made, and that's where it is.